Hello, everyone. Welcome to the market opening bell for Friday, October 31st, your 10-minute guide to the stock market. The C-Trump meeting lasted approximately 1 hour and 40 minutes. China's Ministry of Commerce spokesperson stated that both sides reached consensus on fentanyl, anti-drug cooperation, expanding agricultural trade, and handling cases involving specific companies. Hong Kong stocks traded cautiously on the final day of futures settlement. The Hang Seng Index opened 199 points higher, with gains expanding to 242 points intraday, hitting 26,588. In the afternoon, it briefly fell 207 points to 26,138 before closing down 63 points or 0.2% at 26,282. The H-share index fell 28 points or 0.3% to 9,346, while the Hang Seng Tech Index dropped 41 points or 0.7% to 6,051. Total market turnover rose to 353.8 billion Hong Kong dollars. Southbound Stock Connect recorded a net inflow of 13.641 billion Hong Kong dollars into Hong Kong stocks. Among the top net buys were the Tracker Fund with $4.633 billion, Alibaba with 875 million, Meituan with 805 million, Hang Seng China Enterprises ETF with 772 million, CNOOC with 574 million, Hua Hong Semiconductor with 469 million, and Xiaomi with 201 million. On the sell side, ZTE saw outflows of 323 million, Ganfeng Lithium 306 million, Tencent 264 million, and Innovent Biologics 172 million. Statistically, southbound funds have net bought SMIC for 7 consecutive days, totaling 3.044 billion, and Hua Hong Semiconductor for 4 straight days, totaling 1.92 billion. Technically, the Hang Seng Index remains capped at 26,500, with the Fed rate cut and C-Trump meeting concluded, and no new catalysts. Hong Kong stocks may lack direction in the near term, likely fluctuating between 26,000 and 26,600. Mainland A shares opened low and closed weak. The Shanghai Composite lost the 4,000 level, closing at 3,986, down 29 points or 0.7%. The Shenzhen component ended at 13,532, down 159 points or 1.2%. And the Chinex closed at 3,263, down 61 points or 1.8%. Total A-share turnover was 2.42 trillion yuan. The renminbi US dollar central parity rate was lowered by 21 pips to 7.0864. Among notable movers, ZTE reported 9-month 2025 revenue exceeding 100.5 billion yuan, up 11.6% year-over-year, but profitability plunged. Net profit attributable to shareholders fell 32.7% to 5.322 billion yuan, with Q3 alone seeing net profit of just 264 million yuan, down 87.84% year-over-year, a clear case of revenue up, profit down. The share price plunged over 11%. Turning to earnings, ICBC reported Q3 operating income of 201.886 billion yuan, up 2.4% year-over-year, with net profit of 101.8 billion yuan, up 3.3%. For the first 9 months, operating income was 610.9668 billion yuan, up 2%, and net profit 269.9 billion yuan, up 0.3%. Net interest income was 473.416 billion yuan, down 0.7%, with net interest margin at 1.28%, down 15 basis points. Non-interest income grew 12.4%, while the NPL ratio improved to 1.33%, down 1 basis point, and provision coverage rose to 217.21%, up 2.3 percentage points. Core T1 capital adequacy stood at 13.57%. Overall growth slowed but profitability remains resilient. Agricultural Bank of China reported Q3 revenue of 180.9 billion yuan, up 4.3%, and net profit of 81.3 billion yuan, up 3.7%. For the first 9 months, revenue was 550.7 billion yuan, up 1.9%, and net profit 220.8 billion yuan, up 3.03%. The bank shows strong performance driven by scale and quality, with accelerated transformation in retail, rural, and technology sectors, further strengthening profitability's resilience. Standard Chartered reported Q3 underlying operating income up 5% to 5.147 billion US dollars, beating expectations, with pre-tax profit up 3% to 1.766 billion US dollars, ahead of the expected 1.574 billion. Basic earning per share was 52.3 US cents compared to 39.8 last year. Tangible ROE rose 50 basis points to 10.5%, driven by profit growth, though partly offset by restructuring costs. The bank completed part of its 1.3 billion US dollar share buyback announced in July, repurchasing 22 million shares for 413 million US dollars. China Petroleum and Chemicals Sinopec reported 9 months revenue of 2.11 trillion yuan, down 10.7%, with net profit under IFRS down 28.9% to 32.065 billion yuan. Q3 revenue fell 10.9% to 704.389 billion yuan, but net profit rose 3.5% to 8.313 billion yuan. Oil and gas equivalent output was 394 million BOE, up 2.2%, with natural gas up 4.9%. The chemicals segment posted a loss of 8.223 billion yuan. Chemical losses and low oil prices weighed on performance, underperforming PetroChina. CNO reported Q3 revenue of 104.8 billion yuan, up 5.7%, but net profit fell 12.2% to 32.438 billion yuan. Q3 net production was nearly 194 million BOE, up 7.9%. For the first 9 months, revenue was 312.503 billion yuan, down 4.1%, and net profit 101.971 billion yuan, down 12.6%. Production reached 578.3 million BOE, up 6.7%, with natural gas up 11.6%. Production growth and cost optimization partially offset falling oil prices. BYD reported 9 months net profit of 23.333 billion yuan, down 7.55%, with Q3 net profit at 7.823 billion yuan, down 32.6%. Price wars and destocking caused declines in both revenue and profit in Q3, though gross margin improved sequentially to 17.61%. Challenges remain with high inventory, rising debt, and liquidity concerns. US market digested the C-Trump meeting outcome and closed lower. The VIX fell 0.01 or 0.06% to 16.91. The Dow closed down 109 points or 0.2% at 47,522. The S&P 500 fell 68 points or 1% to 6,822. Heavy selling in Meta and Microsoft after earnings, down 11.3% and 2.9% respectively, dragged the Nasdaq down 377 points or 1.6% to 23,581. The Nasdaq China Golden Dragon Index fell 157 points or 1.9% to 8,230. Alphabet reported Q3 revenue surpassing 100 billion US dollar for the first time, with cloud revenue up 34%, lifting the stock 2.5% to a record close of 281.9 US dollars. Tesla's Cybertruck faced its 10th recall in under 2 years, with shares down 4.6%. Nvidia fell 2%. Apple reported fiscal Q4 revenue up 8% to a record $102.5 billion, beating estimates of $102.2 billion. Adjusted earnings per share was $1.85, above the expected 1.77, driven by record iPhone and services revenue. iPhone sales rose 6% to $49 billion. Services grew 15% to $28.75 billion, while Greater China fell over 3% to $14.5 billion. CEO Tim Cook said iPhone 17 demand exceeded expectations and forecast 10 to 12% revenue growth this quarter, with double-digit iPhone growth and a return to growth in China. Shares rose over 3% after hours. Amazon reported Q3 revenue up 13% to $180.2 billion, beating $177.8 billion at estimates. Net income rose 39% to $21.2 billion, with earnings per share at $1.95, above 1.57. AWS grew 20% to $33 billion, its fastest pace since 2022. Q4 guidance projects revenue of $206 to $213 billion, 10 to 13% growth, and operating income of $21 to $26 billion. Shares surged 10% after hours. Netflix announced a 1-for-10 stock split effective November 17, one of 10 S&P 500 stocks above $1,000. It closed at $1,089 and rose over 3% after hours. Our stock pick today is China Oilfield Services Limited, stock code 2883. China Oilfield Services Limited, COSL, announced its third quarter results for the period ended 30 September 2025, prepared under China accounting standards. Revenue for the quarter reached 11.533 billion yuan, reflecting a year-on-year increase of 3.6%, consistent with the 3.5% growth seen in the first half of the year. Net profit surged to 1.246 billion yuan, marking a strong 46.1% rise compared to the same period last year, a notable acceleration from the 23.3% growth recorded in the first half. This robust profit expansion was primarily driven by higher utilization rates of large-scale equipment and the steady high-day rate operations of the North Sea semi-submersible platform. Earnings per share stood at 0.26 yuan, up 44.4% year-on-year. For the first 9 months of 2025, the company achieved revenue of 34.853 billion yuan, representing a 3.5% increase over the prior year, while net profit attributable to shareholders rose 31.3% to 3.209 billion yuan. Throughout the year, the energy services market has faced heightened uncertainty and volatility, with oil prices under increasing downward pressure at their core levels. Despite these challenges, COSL has remained firmly focused on supporting reserve growth and production enhancement. The company has continued to deliver high-quality equipment for high-value exploration and efficient production, while establishing a robust technology support framework and enhancing comprehensive end-to-end risk management systems. These initiatives have significantly bolstered the company's resilience and contributed to steady performance with positive momentum. In drilling services, the group's rigs operated for a total of 14,784 days in the first 9 months, a 12.3% increase year-on-year. Jackup rigs contributed 11,624 operating days, up 9.7%, while semi-submersible rigs recorded 3,160 days, reflecting a 22.9% rise. Overall calendar day utilization improved to 90.3%, an increase of 11.6 percentage points, with jackups achieving 92.6% and semi-submersibles reaching 82.7%. In well services, the group has consistently powered its technology-driven growth engine by building a core technology system grounded in fundamental research and deepening integration across the industrial and innovation chains. It has successfully extended technical capabilities toward both upstream demand and downstream applications. As a result, the workload of main business lines of well services continued to grow during the first 9 months. In marine support services, COSL operated and managed over 200 vessels by the end of the third quarter, with cumulative operating days totaling 62,589, an increase of 9,427 days or 17.7% compared to the previous year. The company has further strengthened its leading position in the domestic market, improved equipment resource reserves and deployment flexibility, and introduced an innovative Vessel Plus service model to address diverse client requirements. For geophysical acquisition and surveying services, the group strategically concentrated limited production capacity on high return activities and optimized and adjusted the layout of certain production capacity. Consequently, 2D acquisition operation volume was 5,845 kilometers, down 61.8% year on year, and acquisition operation volume was 12,794 square kilometers, a decline of 40.3%. In contrast, bottom operation volume rose sharply to 2,079 square kilometers, up 131.3%, underscoring a clear shift toward higher value ocean bottom node and cable operations. Looking ahead with the introduction of new equipment, the application of advanced technologies, and the broader rollout of integrated projects, COSL is well positioned to capture additional service opportunities. Recommendation: buy at 7.4 Hong Kong dollars with a target price of $8.1 and a stop loss at $7. I do not hold the above stock.